Hey everybody, it's Paul here, back from vacation. I do apologize for the lack of videos over the last week, but Sean and I are definitely going to be back at it again now. And just a quick reminder at the beginning of the video, this is not financial advice. Definitely not a licensed financial advisor, but I've been doing this now for about 5 years and in my opinion, having a lot of success. So I just want to share with you some of the things that I am doing, including this case study. So I started developing this case study back in May. Hard to believe it's been almost a full 5 months now, which I do realize is a short period of time, but every month that goes by, it just keeps proving that this covered call ETF income portfolio is working exactly as I hope it would work. In fact, it's actually doing much better than I thought it would. So I am expecting a little bit on the downside to come eventually, with a pullback or a bear market or a recession. We will see the portfolio value drop and potentially see some of the distributions drop, which we have coming up for the month of November. And I'll go over that as well. All right, guys, for anybody who hasn't watched any of these videos yet, this is the spreadsheet that I put together. It was a recommendation from somebody on Blossom just to keep track of the monthly balances. You can see here in the first column, I have monthly balances for 2025. The ones in green for the first 4 months of the year are when my balance was below 50,000. Then in May and June, it finally hit 50,000 and above, June being a nice 58,000. Finally, in July, I made it to just over $60,000. Last couple of months dropped back down below $60,000. And here we are at the end of October on October 27th, and we're above 61,000. So this is currently the highest portfolio balance I've had to date. We are going to double check it live just to make sure I put this together earlier today. But also you can see in the next column, then we have distributions starting back in January with $813. And then you can take a look, February, 781, got it up to 1,028. And then by April, it was 947. I'd say between, March and April is when I really started shifting the portfolio towards the newer harvest funds, the newer higher yield leveraged funds from Harvest, such as HHIS and MSTE and CNYE. And then you can see the big jump in my distributions, all the way up to 1,350 and then 1,518. August being the best month so far with 1,689. And then September dropped a bit down to 1,604. And so far in October, we're at 1,618. But I have one more distribution coming up this Friday from Alti, which usually around $59 after the 15% withholding tax. So, assuming it's about $50 or more, I should end up with a total this month of $1,600 and about $68 or so, which is fantastic. This portfolio is actually designed to only distribute $1,000 a month, as you can see here. So for the last 5 months, I have taken out the $1,000 and reinvested everything else. I decided last month to calculate what my yield on the average portfolio balance is, which is 22.39%. And then I said last month or last update that I would figure out the yield on cost. So my cost for this portfolio is $58,620, and my yield on that cost is 20.47%. Just keep in mind that this $58,000 is not what I've put into the portfolio. Every month when I get distributions and I reinvest them, that increases my cost basis. Here you can see this is my actual RBC account, and it's live right now. I don't think I can refresh it without logging myself out. But so here I'm at 61,742, which is fantastic. It's, again, way above where I think this portfolio should be, but the market's green right now, so I'm not going to complain about that. So my positions in this portfolio, I have one from Evolve, which is Biggie. Just started this last month. It's a very small position, but I will definitely grow it, probably to at least 100 shares, if not more. It's currently in the green, which is nice. I still have 400 shares of Harvest's Coinbase, which is CNYE. This is the leveraged version. And this one has done very well. I actually had more shares and I sold some of them. Currently up 35%. So that's fantastic on something that's paying such a high yield or a high distribution. Now, this is the new position in my portfolio. I decided to buy HHIC as, I guess, kind of a complement to HHIS. Um, Being that HHIS is heavily, well, it's all US companies and very high in tech. I thought that it would be best to balance that off with some Canadian stocks and not as tech heavy. So that way, when the tech industry or the tech sector drops a little bit, as it always does, there will always be a pullback. Usually, other stocks tend to go up. So it's nice to have a bit of both. So I was able to buy 60 shares of that, and I will continue to build on that position as well, probably between Biggie and HHIC, depending on which one's up next month, which one's down. I'll decide which one I buy, or maybe I'll buy a bit of both. Right now, MSTE is the big talk, or strategy is the big talk for everybody, whether you're buying American versions of strategy like MSTE from YieldMax or MSTW from Roundhill. Right now, they're quite negative. So you can see here that I'm down 32% in this position, which is $4,600. So it's pretty amazing that this portfolio is at all-time highs, over $61,000, even though I'm down 4,600 in this one particular position. I still also have NVHE. I've thought about swapping this out. If it ever gets to be higher than HHIS, I probably will swap it out for HHIS. But right now, the share price is still below. So I'm holding on to this, and it's up 22%. And I still have Tesla from Harvest, which holds Tesla, and always a very volatile one, but right now doing really well, up over 30, almost 36%. And lastly, I have one US listed ETF in this portfolio, which is Alti. I know Alti is a very popular one to talk about it. Some people love it, some people hate it. You can see over here that I'm down 35%, which is just over $2,000. But I think last update I did the math, and making almost $59 to $60 per week. It only takes so many weeks before I surpass the negative, and then everything above that is going to be gains for this year. But either way, I'm taking that dividend and reinvesting it into other ETFs and growing my portfolio. So let's take a quick look at HHIC, which I added to the portfolio. That's the Harvest Canadian High Income Shares ETF. We won't spend too much time on this. It is Canadian listed, so I don't think Americans can buy it. And I was thinking about this. I don't know if there's anything similar in the States where you can buy a fund-of-fund ETF that holds Canadian stocks. So that's maybe something some American managers need to consider doing. I don't know if there'd be enough demand, though, for it. The ticker's HHIC. It's paying 16 cents a month. The NAV is 1342. The market close was 1342. Assets under management are already at 92 million, which is pretty amazing for a Canadian ETF. Of course, HHIS has already surpassed 1 billion in assets under management. So let's look at the fund focus here. Harvest Canadian High Income Shares ETF seeks to provide high monthly income and growth potential from a portfolio of TSX listed equities that use covered call strategy. The underlying ETFs in this ETF employ modest leverage to create overall leverage exposure of approximately 25% and high monthly cash distributions for its unit holders. So some of the advantages are diversified exposure to top Canadian companies, Canadian stocks and high monthly income. It's tax efficient. This is a one-ticket solution with lower purchase price to access underlying ETFs. and the modest leverage of 25% to generate enhanced cash flow and growth potential. All right, we'll just take a quick look at the holdings for anybody who's not familiar with it. You have the biggest tech company in Canada, which is Shopify. You do have some telecommunication companies, TELUS and BCE, which I'm not a big fan of. I'd like to see TELUS do better than they have, but we'll have to wait and see. You have two of Canada's biggest banks, which is RBC and TD Bank, Cameco, Canadian Natural Resources, Enbridge, Suncor, and Inigo Eagle. So this isn't just a tech-heavy, ETF like you get with a lot of the U.S. listed ones. So I think this is great for diversification. Just to show you here, first of all, I changed the colors because it's Halloween's coming up. So I put in some orange and I left the green for bought positions. But anyways, I did add at the bottom here, on October 24th is when I bought my 60 shares of HHIC. I paid $13.37, was $812 worth. All right, guys, just in conclusion, so this is my monthly case study where I have a tax-free savings account, which is our Canadian tax advantaged account where we can put money in after we pay our taxes at work, but then we can withdraw anything from it tax-free. It's my smaller tax-free savings account with RBC. So the goal is to be able to withdraw at least $1,000 a month and maintain the integrity of the account. In other words, I don't want them to just be paying me back my own money and in 5 years from now, the account's at zero. So far, we've only been doing this for 5 months, but the account has done extremely well. And I know we're in a bull market, but if they were just paying me back my money and there was no share appreciation, there was no premiums, there was no dividends being paid out to these ETFs that are being held within the portfolio, then the account should be going down instead of maintaining itself or going up. Now, as I mentioned earlier, we did have a dividend cut, which was MSTE, dropped its distribution from 55 to 45 cents. Hopefully, eventually strategy will start to do better. MSTE will improve its share price as well, and then maybe we'll get a dividend raise or a distribution increase. HHIS did increase their distribution from 25 to 26 cents. So that kind of helps balance things out a little bit. Other than that, guys, if you have any questions about this particular case study or this portfolio, leave them in the comments below, and then I can try to add that into my update in a couple of weeks from now. But other than that, just remember, guys, I'm not advising anybody to purchase these particular ETFs. Do your own research. If you want to become a passive income investor and buy covered call ETFs, make sure you know what it is you're buying and the pros and cons of this strategy. For myself, it's working fantastic. I'm basically retired now and living off my portfolio, so I'm having a lot of success with it myself. But again, obviously, it's personal finance for a reason. It has to meet your needs, right? It doesn't matter if it works for me. It has to work for you, depending on your age and your situation and all of the rest of it. All right, and just remember that everything does have risks. Okay, I think I've discussed this before in videos. Covered call ETFs have risks. Some of these ETFs have not been around very long. Management fees are considered to be high. If you have a single stock ETF, then you're putting all of basically you could say your eggs in one basket, right? If you own CNYE, then you're depending on Coinbase to do well. So just make sure you understand what the risk is of what you're holding. And in my recommendation or suggestion, I would say make sure you're diversified so that not one particular position in your portfolio is going to hurt you to the point where you can't afford to pay your bills or live off of your portfolio. All right, guys, until tomorrow, bye for now.